welcome to this price ladder training video. And what we're going to do today is a price action setup called an accumulation zone or sort of accumulation distribution zone. And what we're going to start off with is I'm briefly going to actually show you what it looks like on a chart, so give you a visualization of how it looks. But then more importantly, get you to understand the principle behind the trade, but then also get you to understand, where the edge is in executing and being profitable in this trade. So what we're looking at is, it was from the 5th of April, which is yesterday. It is the oil market, so the WTI NYMEX oil. And so very interestingly, before we go on, I think I need to paint a little bit of context. And so what we're going to do is we're going to start off with this chart, and this is the daily oil, using market profiling. And what I've got on the left here particularly is what we call a composite profile. And what it is it effectively shows me as a trader over the course of this year, because that's what I've used, where has volume been trading most in terms of volume and price, but more importantly, where has the market sort of accepted price? Where has the market said to itself, this is what we deem fair value? Now, as you can see very clearly that over the course of this year, this price point between $35 and $36 has been very highly accepted between buyers and sellers, and they've come to an agreement that that is a fairly traded price with regards to where oil is now and the fundamentals. Now, what the trade is or what we typically see with trading is that you always find that when a market, or once a market has accepted an area or a price as fair value, once it then navigates away from that, for instance, once we navigated up towards that $42 a barrel, when it then first comes back to retest that accepted price, it now no longer, it effectively turns from acting as an area where the market traded a lot of two-way price to then becoming an area of almost rejection. In other words, the market says, we've moved away from fair value, we've come back now, but we accept that we were accepting value higher up. So what you typically see is very aggressive type price action coming in when we retest these high volume traded areas. So that's the context of the market. That's what it looked like moving into it. Now, what I want to talk about is effectively what we identified and what we saw down at this $35 a barrel. So I'm going to move over actually quickly straight into the price action, and what I want to show you is maybe not necessarily what happened on the day or the outcome of what happened in oil yesterday, but I want to show you a very sort of a trade setup now that we used to execute a long trade. Now, the first thing to point out is this is a 1-minute chart that we're looking at, and what I'm going to show you effectively is the oil, it's sort of almost come into this very tight range between 35.24 and 35.40, and the market kind of just kept pinging between these, this very tight 15-16 tick distribution. Now, what tended to happen here, or what was occurring here, was that someone was accumulating a position, but he was accumulating at lower prices. He would then buy the market as the seller stopped selling it to him. It would then come back down again. He would lift the market or buy the market and hold the market bid, and then start buying as the seller stopped. And he kept doing this over a period of 10, 12, 15 minutes. Now, very often, or where the trade is once that buyer, in other words, once the seller identifies that that buyer is now complete, once the seller then identifies that there is a very strong buyer in the market and he completes his sell side order, the buyer then continues to buy the market up. Market back up, because there's no longer a seller offering the market. So let's have a look at this. Let's see how that played out. Very simply, what we're looking for is once we can take out and hold above higher prices, so these sort of 37s and 39s, we then expect that resistance, or that point where the seller was selling, to then turn around and the buyer to start holding that resistance as new support. So that's what we're going to look at in terms of price action. Let's roll the camera and see what we can pick up. So note the key prices. 35, 39 to the upside is our resistance, or that point where the seller keeps continually hold the market or stepping in to sell the market. Now, let's see what happens once this buyer ultimately actually gets to those 39s and hold it. So we've come up to test the oil. As you can see, this market on the left here, that's where we're looking. And as you can see now, we're sitting on those 39s. Clearly, we still have a seller, so we can see someone just still holding on to those 39s. But let's see how this buyer responds now once the seller stops. So the buyer goes firm on the 39s, Okay, he holds a bid. You can see someone sold 3 and instantly lifts the full offer at 4. So the full offer got taken at 4s and the buyer went to 41's next best price. So now we can see, we know that this was resistance, so we can see now the buyer, there's still a bit of selling, but the buyer is now absorbing higher prices. Whereas before, what would happen is every time we came up to these 39s, the market would navigate all the way back down because the bid would get pulled away. Whereas this time around, we can see that the bid is holding firm. So make sure you understand that. It's a very, very important concept to understanding this trade setup. So again, we can see someone selling 39s, but the buyer continues to reload. In other words, he's putting more and more contracts there, looking to buy the market at that price. Okay, lifts 40, lifts 41, straight on to 42. Okay, again, note, seller sells 41, sells 40, sells 39. What does the buyer do? Again, he reloads. So what we're looking to do now, the minute we identify this, we want to look to actually go and buy the market. Okay, so again, 39 reloads, all right? And again, let's see what happens on the 38s. So we can see someone selling it. There is a seller here. Right, but note the buyer is holding the market here, holding it, bid as long as he can. Okay, let's quickly just keep an eye on this now for the next minute or two and see how this buyer responds now once he starts to take higher prices. As you can see, again the 38 reloads. The buyer shows his intent. He keeps reloading. So whilst the seller is selling to him, why would he go to higher prices? If someone wants to sell to him at lower prices, he'll keep taking that. But what happens, and this is the question, this is where you have to interpret it, is what happens once the seller is done selling? Okay, if the buyer still got a lot of orders to do, he's then going to go to the market, turn from being a passive buyer to being an aggressive buyer. Okay, again, we reload the 38s, and again, the buyer steps in with more. So he keeps reloading and reloading and reloading. Okay, let's move this on a little bit and see what happens now once we start to lift higher prices. So the buyer's gone back up to 40s. Okay, again, though, we can see a seller sitting on 41s, 40, and again, the seller's selling in. All right, note the last highest price we traded was 35.41. So again, we want to reference that price because that is the last time or the point at which a seller keeps stepping in. So what occurs once we can get above those 41s? Okay, 41s trades straight onto 42s. 42s trades, reload 42, lift 10 at 43. So again, note the reload at 2 and lift at 43. Okay, note we still see a little bit of selling coming into the market, right? But what occurs now is very, very different to what we've seen in the last couple of minutes. Previously, what was happening was the seller would sell, sell, sell. So you would sell to 3 different prices. Whereas now, suddenly, the buyer's holding on to higher prices. So previously, the buyer held 38, 39. Now the buyer's looking to hold on to 42s and 43s. Okay, let's move this on a little bit further and see what occurs now. So again, we can see reloading 42s, reloading 43s. We can see this buyer holding higher and higher in prices, turning what was previous resistance into new support. Okay, again, the market comes back to those 41s. And again, buyer steps in, reloads the 42s, 43s. So what you have to understand is at this point is that there's no directional price action here. What we have at the moment is a really big buyer who's been accumulating, as I showed you as per the chart earlier. So he's been accumulating. He then started to become a bit more direct in his price response, but he's still incurring or running into sellers. All right, and that's the tricky part. As a day trader, we don't want the two-way trade. We want to see the seller step out of the way and get the buyer to take the market very aggressively bid up the page. Okay, again we can see 43s now holds, 44 holds, and 45 and 46 is lifted. All right, so again we can see a little bit of a sell side action comes in, but we can see now that the seller is starting to lose sort of ground. He's starting to give way to the higher prices, and the buyer is starting to show his sort of muscle or his intent on the market. Okay, let's move on a little bit further and see what happens when eventually the seller gives way. As you can see now, we're again continuing with this pattern of sort of the buyer lifting higher and higher prices, absorbing higher and higher prices. But what happens once effectively the seller goes sort of gives up and the market then goes bid? So as we can see, we've got a real 120 lot. Now, very important, guys, when you're trading price action, if you're looking to be a buyer of the market and you're watching the price action closely and someone comes in, for example, and they lift 100 a market like they just did there, that's a very strong clue. It's showing the intention. It's showing that there is a buyer that wanted 100 lots of liquidity, at higher prices, and that's a very, if you're long, as this trader is in this instance, that's a very positive sign for you, because it's showing a buyer that's not only holding higher prices, but also a buyer that's willing to lift liquidity at higher prices. So let's then roll on and see what happens once we take out those 50s. So again, note we're now sort of continuing with this higher and higher prices. Market comes back to 41s. And again, that same price that was resistance earlier has now maintained its support. So again, note, guys, if you didn't get filled, if you were a little bit reluctant to buy it, you're a little bit afraid, just understand the market came all the way back to those 41s, and it gave you the chance, to execute based on how you're interpreting the price action. Okay, note, we saw 100 lots lifted at 50. Let's see what happens now once we get above those 50s and, lift up above them. So the market goes back to the 50s. Let me rewind that a bit. Okay, so second time around, market comes to the 50s, and straight away buyer lifts 50, lifts 51s, and, goes to the market, shows a little bit more aggression, continuing with that buy side order flow. Come on. Okay. All right, lifts the 2s, lift the 3s, and the market then continues to rotate up the page. So again, let's just look at that chart now. Let's pause this briefly. Let's take a look at sort of what we've done over the course of this price action setup. So we can see the market sort of accumulated in this area. There was quite a lot of accumulation over a period. The buyer then trumped the seller. He showed his intent. He took the markets back up to the 50s. Came all the way back, turned that resistance now into new support, and then obviously continued higher up the page. Okay, so what we ultimately did then, the oil did extend on the highs of the day. It went to make a new high before then coming back and coming back down, and surprise, surprise, actually testing those 41s and holding as support yet again. So that's pretty much our raw price action trade setup for today. It's called an accumulation and distribution trade setup, simply because we have sort of a two-way interaction in a very tight zone. Once that interaction is done and the one side sort of wins the victory, the market then, or the bigger long-term player that wins, then starts to continue with his order and gets it filled out, and we then extend on prices to the upside, or fall in prices to the downside. So that's effectively our trade setup for today. What I do want to just leave you with, and this is the most important thing to understand, is that these sort of setups, they don't just occur on the 1 minute time frame I've showed you there. What we ultimately saw yesterday, and this is the oil from yesterday, is we ultimately actually saw the market accumulating a really large position. So over the whole entire day, if you look at this looks exactly like the 1 minute chart I just showed you, where the market would rally, then the seller would step in, then the buyer would buy lower prices, and then we would see the sellers come in, and then the buyers would step in and the sellers would come in. And over the course of an entire day, over a 24-hour period, we saw the buyers and sellers interacting. Once we took out that area of resistance, the market then spiked higher in prices, came back to retest the support before we got a very aggressive move to the upside. So again, guys, this is a longer term time frame for longer term traders. It's a 60-minute chart, and we can see that the market offered us almost 100 prices relatively fast on a very simple trade setup. All right, I'm going to leave you with that. Go have a look at it. Go back on the price action. Pay attention to where those key little points are, where those entry points are, where your risk is. If you understand where your risk is and you've got a good idea, bang, you've got an amazing setup. You got any questions? Feel free to tweet me. Otherwise, good luck for the rest of the session, and we'll catch up again soon.